To find the best trades, do you keep jumping from tool to tool and just end up going around in circles? Well, what if there was another way and you could just have one combined multi-tool which did everything all in one? For volatility indicators, most people would look at the Bollinger, Keltner, or Donchian bands, but I've found something much better, which is this combination cloud from MDX Algo that essentially combines all these three bands indicators into one simple tool for some unbeatable trade setups. However, if you don't understand how to use the tool correctly, you will ape in at the wrong levels at the wrong time and lose all your money. So I've created this simple guide to Bollinger, Keltner and Donchian logic used in the Combination Cloud tool so that you have the knowledge to become the alpha chad of volatility trading. So to recap the Bollinger Bands, they are constructed using a simple moving average line, and then we take a standard deviation above or below that line and plot those standard deviations in a band like that. And if you'd like to understand this in more depth, check out my video popping up above for an in-depth guide into Bollinger Bands. Now, the implication of this is that when we go from ranging price action with low volatility to trending price action where we get the spike in volatility and larger candles, the Bollinger Bands blow out very quickly and respond immediately. And that's because the standard deviation is calculated on a per candle basis. So as soon as this trend gets going, that volatility reacts immediately the first candle that starts spiking up. So due to the way the Bollinger Bands logic is constructed, we can use this information to look for volatility squeezes. And this is when we see a period of low volatility with tight Bollinger Bands, which often occurs before large expansions or contractions in the price action. A secondary use is also to look for mean reversion. So when the price touches the outermost Bollinger Bands, there may be a mean reversion back to the center line. Although personally, I find this is most useful for timing my trade entries and exits based on those volatility changes, which I'll show here on the Bitcoin chart. And I'm just using the basic Bollinger Band indicator from TradingView. And here we can quite clearly see these big shifts in the width of the Bollinger Bands. So for example, back in January, February time, when Bitcoin was sitting at around 40,000, you can see that the Bollinger Bands width was fairly narrow and the price action was very stable and muted and not much was happening. And gradually, between January through February, those Bollinger Bands are tightening in and squeezing right in. And then on the 7th of February 24, that price move gets started and we start to see this expansion, and very quickly those bands are blowing right out as we saw on the whiteboard. And that's when we get that trend shift and this big move up from 42 up to around 51,000. And then it happens again towards the end of February. There's another squeeze in the bands, and then the price blows right up from 50 up here to around 60,000. And then even there was a third opportunity. You see here, bands tightened in again. Zoom in a bit. And then we got a third move up from 61 up to around 70,000. Now, this highlights perfectly why I prefer to use this for timing these expansions and contractions in the Bollingers rather than looking for those reversals, because it's easy to see this with hindsight. But let's say here, when the bands first started blowing out, well, the price action touched the upper band. But if you were looking for the reversion back to the midline and tried to short that, you would have got absolutely wrecked, because price just kept going and going. So that's why personally I tend to use this more for looking for the timing of those expansions and contractions, because it's just more useful for that tool. To recap the Keltner Bands logic, instead of a SMA, this uses the exponential moving average as the midline. And check out my video here on SMAs versus EMAs for more on that. Next, the Keltner Bands takes the average true range and then adds that value above and below the EMA line, and then plots the bands using that ATR calculation. And also check my other video here on ATR if you'd like to understand that in more depth. Now, why is this important? Well, the Keltner bands behave differently because we're using these different inputs. And the first point is that the EMA line is more reactive than the SMA line with the Bollingers, because the EMA is weighted more to the recent price action, so reacts to that trend and spikes up more quickly. However, the ATR is based on a rolling 14 period look back, or 14-day look back. So in this case, the ATR bands are somewhat slower to react to this increase in volatility, because even though the candles are spiking up as before, the Keltners, due to the way this has the average 14-day calculation, that reaction to the volatility is more smoothed out. And that's the reason why the Keltner bands kind of track this channel more closely and don't blow out like we saw with the Bollinger Bands so much. So due to the differences in the calculation logic with those Keltner channels, we can use this in a slightly different way. And I find that the upper and lower Keltner bands are more useful for support and resistance levels. Also, if you are looking for trend reversal plays, then when the price action moves outside the Keltner bands and then starts dipping back in, they can be really good potential reversal trade entries. And lastly, in terms of volatility, you will see an increase or decrease in the width of the Keltner bands as the volatility changes, but that will be slightly more muted and a bit lagging due to the difference in the way that rolling 14 period ATR calculation works. So generally, I find with the Keltners, these are better for reversal plays, particularly during ranging price action. So I'll just show that on the chart. And again, I've pulled up the Bitcoin chart, but I'm looking at more recent price action in the last few months up until August, September this year, where you can clearly see this is a ranging price action period. Now, if we zoom in a little bit, here is the Keltner channel indicator, which is just on the standard settings with that EMA line in the middle. And yeah, I mean, just look at the candles. You can see when it's kind of hit the highs, we're tapping that top of the Keltner channel, and then it dips back down. Here at the lows a bit earlier in August, we came down to around 50,000. Zoom in even further. We dipped outside the Keltner channel, and I'm on the 4-hour chart, by the way. And then when the price action came back in, that would have been a nice long entry to then move from the lower Keltner channel back up towards the upper channel. And there's loads of opportunities like this with this tool in the price action. Here's another one in July from 54,000, hit the bottom of the channel, and then moved all the way up to 70,000. So that's the Keltner channels. The Donchian Bands logic is perhaps the most simple of the three, because this just looks at the highs and lows of the candles over the last 20 days. So for example, this low point here in the candles, the Donchian Bands is just drawn as a horizontal line, and then as the candles move up after 20 days have passed, this will shift up to the next low, and then the next low, and so on. And similarly for the high points, when you get to the high, it draws the horizontal Donchian upper band, and then after 20 days, that will step down lower, like so. And then the midline is very straightforward. This is simply just the high plus the low of the Donchian bands divided by 2, and then the blue midline is plotted usually roughly halfway between the upper and lower bands. Due to the difference again in the Donchian logic, we can use this for a slightly different strategy. So with the Donchian's channels, it's quite good to identify potential breakouts because when price is moving above the upper band, and then you also see the lower channel band moving up, that may indicate the beginning of a bullish or bearish breakout. In terms of volatility, if you see the upper and lower line squeezing in opposite direction, that usually shows indecisiveness, showing a large move incoming, although I tend to prefer using the Bollinger to identify that particular aspect. And then in terms of trend following on the Donchians, when the prices consistently keep hitting the upper band, that suggests there's a strong uptrend in motion and we're likely to get a continuation. And lastly, because the Donchians show that last 20-day horizontal line, we can use those levels as a good point for potential stop loss place to set our stop loss. So looking on the chart, here is the Donchian basic indicator, which is very, very straightforward. And as we saw before, it has these horizontal lines at the highs and lows. And then here we can identify a potential breakout trend starting, because when the candles are hitting the highs of the Donchian channel, we're also seeing the lower channel trending up at the same time, and that means this breakout is beginning. And then as the candles keep moving the top of the Donchian channel higher, that means a likely continuation. So you'd normally use this to get into the trend and stay in the trend. And actually in this case, that would have worked very nicely. So you can begin to see for the three different tools, there are slightly different, subtle differences in how you use them, even though they're all designed to measure volatility. Before applying these different tools in the Combined Cloud tool, there are a couple of issues to be aware of. And the first one is to do with time frames, since ultimately all these bands tools will vary where the levels are set on the chart depending which time frame you're using. So for example, here on the Keltner channels, I'm on the daily chart, and if I draw on the high point, let's say on the 1st of August, and then I highlight the low point also on the 1st of August there, okay? Now let's jump down, let's say to the 1 hour chart and look at the same date on the 1st of August. Just scroll back. Yeah, there you go, look. Now the Keltner bands are in a completely and totally different place. Like on the daily, the high was at 72,500, but now it's down here at, what's that, 67,000. I mean, that's a huge difference just because we've shifted time frame. So the solution to this, because ultimately there are an endless number of different time frames, I've found that usually the daily and the 4 hour are the most respected levels, because essentially that's what everyone else is looking at. So it can be a little bit self-fulfilling. So when I'm looking to find the correct levels, I'll start on the daily and 4 hour, and then I may drop down to the lower time frames, still use the tools, but use those mainly for my trade entries and exits. The next issue is that these three tools can ultimately give conflicting signals for reversals or continuations, yet the upper and lower bounds are often in a similar place. So if I turn on the Bollinger Bands, now the Keltner channels, and the Donchian Bands all at the same time, you can sort of see that roughly the upper band and the lower bands are sort of overlapping, roughly speaking, in a similar place, and so is the midline. Yet we saw earlier the Keltners you may use for reversals and the Donchians you may use for continuation. So what's the solution? Well, I've found that the secret here is to kind of stack these, and you use each tool for what it's designed for to help you slowly build up a picture and formulate your trade setup. So for example, if we go back to this, you may start off, let's jump down to the 4 hour. You may start off looking for a potential expansion in price where you see this squeeze in the Bollinger Bands, like here back in February on Bitcoin. And then when the price action starts breaking out and you suddenly see the Bollinger Bands expanding, then you might switch to, say, the Donchian tool to see if the trend is actually starting to shift. And here you saw later on the bottom band starts curling up with the upper band. And then you might turn on the Keltner channels to look for an entry. So let's say you missed this at the beginning, but you know the volatility is blowing out, you know the trend's shifting because of the Donchians, and then you might say, all right, well, I'll look for a pullback to the Keltner channel midline, or even down to the bottom channel to get in on a later trade and then ride the second part of the trend. So yeah, stack those different tools to build up a complementary picture. The second thing is that generally I wouldn't use these three bands as your primary signal. Really, you should be using the market structure and the swing levels as your primary kind of indication of what you're going to do, and then you can add the bands tools as a secondary consideration. And that brings us to confluence. As with all these tools, you've got to build confluence between multiple indicators, multiple factors, and build that picture together. So there you go. To take your volatility trading to the next level, MDX Algo have combined the Bollinger, Keltner and Donchian logic all into one combination cloud tool, which is this here that you see on the chart in the green and red clouds above and below the price action, with the moving average line in the center, which also shifts from green to red depending if we're trending up or down. Now, to explain what this is doing, the outer bands of the cloud, or the outer line, well, that is most influenced by the Bollinger logic to show you when the volatility is shifting, because the outer line of the cloud shows whether the cloud is widening or tightening, indicating the volatility shifting up and down. And then the Keltner logic is used both on the inner outer parts of the cloud to help show when a trend shift is happening. And lastly, the inner line of the cloud, that focuses more on the Donchian logic, because it's trying to help you highlight support and resistance levels. And then that is even further enhanced to remove some of the noise. So if I hop back into the chart again, I'll show some examples. So for example, on Bitcoin, back in that February period before we saw this big expansion up in price and shift to uptrending price action, you can see the cloud here tightened in to a very narrow cloud. And that is showing that Bollinger logic that we might be expecting a blowout in either a price expansion or contraction very soon. And sure enough, when that trend shift and move up began, then the cloud starts widening as the volatility goes up. The next thing is the Keltner logic in the bands. And here, if we zoom in a bit further, you can see that when that price trend got going, both the upper part of the cloud and the lower part of the cloud are both shifting up to follow that trend. So that can help you to know when the trend shift is happening. And then last of all, the Donchian logic helps to show the support and resistance levels. And that is based on the inner line of the cloud. So here above the price action, you can see that inner line where price came up, hit around 63,000, and then that was acting as resistance. And it took several attempts until eventually the price did break through. Or a bit later, here you see it happened again. Price moves up. It forms a new horizontal line based on that Donchian 20-day look back. And then that was the new resistance. And then later, price came up to hit it again, it found resistance multiple times. Eventually, it did break through. And then to the downside, when Bitcoin topped out around 70,000 in March, and we got the rotation down to around the 60,000 area, that inner line forms kind of this support area, and price bounced off that. And you'll see lots of these where you can use that inner line of the cloud for these support and resistance levels. So now you understand how the combination cloud tool works. How can you actually use this in your trading to make money? Well, the first thing that I do is I use that outer layer of the cloud as a reversal point, because it's very rare that the candles or the wicks will actually move past there, particularly when the inner cloud line doesn't move. So let me show you what I mean on the chart. So here on Bitcoin, back in August last month, you can see that the cloud is forming these upper and lower channels. And then you see here where price comes down to around 57,000 and we get this wick on the 15th of August. Well, actually 2 wicks on the 14th and the 15th, but neither of those wicks go past the outer cloud line. So, you know, if you were trying to get into a long trade there, a good place to set your stop loss might be, you know, near that outer cloud level. And also, because the inner cloud line hasn't changed, you think it's less likely this is going to continue as a trend down, and you might get that bounce. So, you know, had you got into that long there, you would have got a nice move up from 57,000 up to around 64,000 over the coming days. The next thing you can do is that when the inner cloud line does start changing and moving up, that highlights the trend shift is actually happening. So coming back to that example, let's say you did get into that long trade, you'd made some initial profits over the first couple of days, but then you start seeing the inner cloud line moving up. Well, then you might think, okay, we are getting a nice trend shift here to upwards trending price action, and also the upper lines are also starting to move up. So you might stay in that trade a bit longer. The next concept is to think of this combination cloud like a spring. So the deeper that the candles or the wicks go down into the cloud, the more of an aggressive bounce back you're likely to get. So I'll try and find a different example of that. Let's go back a bit in the price action. So yeah, here look, you can see the wicks into the cloud are relatively small, so we're not getting that much of a reaction there. Whereas let's find one that had a much stronger reaction. Okay, here, for example, back in March, we saw price dump from 68,000 down to around 58, 59,000. And here, the candles have gone really deep into that cloud. And actually, it's quite rare. It's actually wicked past it and then back into the combination cloud. And then after that, we've got a very aggressive and fast spring back up and out. And also there was no change in the inner line, so it's less likely that this upward trend was shifting to downwards price action. So that gives you a bit more confidence. And in that case, yeah, there was quite a big spring back up out the cloud from around 61,000 up to 73,000, which is a 20% move. The next point is on time frames, and again with the combination tool, this will work on all time frames, though generally those higher daily and 4-hour time frames will tend to give bigger multi-day macro price moves. Although even with that, this should still be used as a secondary confluence, not the primary signal. And I would be looking more at market structure and swing levels and then bringing this in as a secondary factor. The next technique is to use those higher time frames for finding your macro trends and trade setups, but then jump down to the lower time frames to get better entries and take profit points. So here, for example, on the daily chart with more recent price action, we can see that here around 29th of July, Bitcoin was hitting into the cloud there. So you might draw on the entry setup you've seen on the daily. And then now let's jump down to the 1 hour time frame. zoom in on that section of the price action while the indicator loads. And now you may be able to actually find multiple points to get into that trade and try and, tune this in where you might set your stop loss a bit tighter on the outer line, use the inner line for potential trade entries, and then zooming in a bit more, when you see the candles dipping in to that cloud, then you might expect the rebound back down. Pro tip: to really get the most out of this, you can dial down the band's emphasis to, make sure you're not relying on this too heavily. So in the menu options here, underneath the combination bands, you can go into the colors, and for example, you might choose gray, and then you can adjust the transparency. And if we just let it load, you'll see that this removes that red and green, which can kind of give a psychological, too much emphasis that price will never go past there. And the other nice thing with that is now you can kind of see the trend line shifts a bit better on that moving average from the green to the red. So those visuals can really help. Another thing is, I just encourage you to experiment. This combination cloud is an advanced tool, and you may find that some features work better for scalping and some for swings. Also, it will vary a little on the asset you're using, if it's stocks or crypto. And as we saw, it may also change based on time frame. So it does require a little bit of experimentation and figuring out what works for your strategy. And then last of all, I would say, don't try to use this bands tool for some kind of, perfect entry, because there's no such thing. You need to focus more on scaling in and out of your positions, making sure your risk management is on point, and looking for confluence with other things like market structure, swing levels, and maybe other indicators like RSI. So there you are. That's my pro tips for the bands tool. So that's it on the combination multi-bands tool. And I hope you found this helpful, and it helps you to improve your understanding and trading of volatility using all these advanced features. Now, this will be my last video on the theory side for a while, because if you've been watching the last weeks and months, you'll see that each episode has been building on top of the next one, and it's all culminating in the finale episode next week, which is on the flagship Trendmaster tool from MDX Algo, which will bring together all these different powerful features into one of the best tools of the lot. So definitely don't miss out. Hit the subscribe button and notification bell to make sure you catch that next week, which is not to be missed. Also, if you've got any questions and you'd like to see anything in the last episode, then drop some comments down there. Love to hear what you think. So that's it from me. I'm going to have a play on the charts, see if I can find some nice sniper entries and get those gains. So I'll see you in the next episode. Take it easy.
Bang.